There's a couple different ways to use them. A lot of traders use them to try and trade in between, buy when it hits the lower band, sell when it hits the higher band. That's one way to use them. Another way to
Welcome back, traders and investors. We have Ezra Rapoport on the line. He's the trader and head of automated strategy and development for Flammarion Capital. How you doing today, Ezra?
I'm great this morning. Thanks for having me on.
Ezra, I just want to know how your typical trading day starts, and take us through a typical trading day in your high-frequency trading world.
Sure. Well, I drag myself out of bed as early as I possibly can manage after staying up as late as I can manage. Basically, it's a constant situation of, being understaffed, and in the futures markets, we open at 6 p.m. The session opens 6 p.m. the day before for the Asia session. So for me, we do a good amount of volume overnight, and with the stress of constantly rolling out new strategies and new markets, it's very difficult to let the strategies run overnight, and not be constantly monitoring everything. Obviously, I can hand it off to a night trader and that kind of thing. But so basically, I stay up till about midnight, and I wake up at about 4. Get myself into the office. Yeah, during the week I don't sleep very much, and first thing in the morning when I get into the office, I've already been checking my trades for hours. Fire up my Bloomberg, fire up my news sources, check the numbers for the day.
So when the markets close Friday night, do you just sleep the entire weekend away and catch up for all that sleep you didn't get during the week?
Friday night, yeah, it's a special time for me. But I find that there's diminishing returns for me on the catching up on sleep after 8 or 9 hours on Saturday. Really an extra hour or two there doesn't make much of a difference. So, I try to get full nights on the weekends. But definitely taxing during the week. As far as go ahead.
Are your systems running like Monday, Tuesday, Wednesday? Are they running the entire 24 hours, or pretty much trading the entire time that the futures are open?
Good question. Yeah, we are absolutely open. The futures are closed for 45 minutes between 5 and 5:45, and that's our maintenance period. That's when we'll go onto our servers. Make any necessary changes that need to be made. Hopefully that's infrequent. Updates to configuration files. So we have a 45-minute maintenance period every night, before the market reopens. And but other than that, yeah, we are absolutely up for 23 hours a day, for 5 sessions.
So you're just you design the systems, and you have your maintenance period. So you're pretty much just letting them run on autopilot then, right? Once you turn them on at 6 o'clock and let them run, there's very little human discretion involved in the trading.
Yeah, it's a difficult dynamic to get used to, but virtually 100% of my volume, if not 100%, is completely automated. So from after the maintenance period, once we send our blast of our our opening markets, that's it for the next 23 hours. Pretty much, I'm watching it carefully. I'm involved in development and other aspects. And I'm constantly watching the trading, but none of the orders are placed by hand. And insofar as the trade performance, all I can do is watch. Basically, I can cut it out, but it's we try to avoid that.
How many trades are you making in a day? Did you ever sit down and look at the numbers and see how many trades? Just give us an example of how many trades your systems would make in a day. Yeah,
I'm absolutely cognizant of that, because the more we do, obviously, the better our performance, generally speaking. So we're doing we're doing in the thousands to 10,000s, and then that's on these normal slow days. And then, basically when we get to quarterly expirations or, other events where, the volume is driven up in the futures, which is, where we like to be on those high volume days, things can get into hundreds of thousands of transactions.
Oh, wow.
Absolutely.
Wow. So how did you guys perform through this whole Ebola mess there? Do you like it when the market starts tanking like that? Like, is this better because of the volatility being up? Do you guys make more money, or do you kind of sit back and try to let the market calm down a bit, or do you get more aggressive when the markets are volatile like that?
We loved it. The week before and this past week, the return of the volatility drives significantly more volume through our strategies. We had I guess about a week and a half ago now, when there was that large move in Treasuries and corresponding move in the market. We got a couple days there where we did a week's volume in a day, which was great for us. That kind of thing. That's what we look for.
Is it mostly arbitrage? Is that what you're really trading there? It's like just the price discrepancies, or are you guys making
arbitrage? We trade noise basically. We're looking for that jitter. We're happy to improve the bid and offer, and pick up the spread there, and that's basically what we're doing.
So there's no fundamentals. There's no, you could care less about the fundamentals. You're just trading your systems based on either technicals or the other, or are you keying off other orders that you see in the market?
That's largely true. I'll come away from some days where, someone, will ask me at the end of my day, they'll say, "Oh, you're in finance. How did the market do today?" And, and the truth is some days I don't know. I have no idea how the market did. Basically, our view is, it's fairly tunnel vision, restricted to basically the execution, much less than the fundamentals. But that said, I was trained by former floor traders, and when I started trading, we had squawks on our desks, and we'd get color from the head of the shop in the morning, lots of technical views on the treasuries. So I can't really help but see things through that lens. But at a certain granular level, that you're correct in that the strategies are really just concerned with triggering off of, bid-ask changes, top of book changes, fills, and that kind of thing.
What's your average holding period there? Are you in for just milliseconds, or sometimes are you in the trades, like going with the trend and going with the flow and taking even more out of some of your scalps?
Definitely, anything from the millisecond scale up to, the half-hour scale, absolutely.
That'd be like a long-term investment for you, a half hour or an hour. I suppose that technically it's possible that, depending on how you account for it, we get stuck with positions for a couple hours, possibly. I suppose that's possible.
Ezra, I want to ask you about some action that you had. I'm just pulling up the TLT here, the ETF, the 20-year Treasury bond ETF, and that unprecedented move on October 15th. This thing spiked to 127.68. I'm sure you had a corresponding move, in the actual physical bond futures. How did you not get run over on the short side on that?
It came back actually. But the truth is, while that's happening, I think everyone's getting run over, and there was absolutely a corresponding move in the entire Treasury complex to what you see in the TLT. And the way that you don't get run over in that kind of move is that if you have directional exposure, you hedge it up on the curve. If you're short at one point, you get long the neighboring points on the curve, and you ride out that move. Most of my strategies are basically are already trading Treasury spreads, so they're already hedging themselves on the curve. And the thing is, the curve relationships actually stayed remarkably stable during that wild move. So if you had accurate hedges on, if you were in those spread markets, then you were a happy camper during that move, because there was just a lot of volume that really didn't move very far in the spreads. The outrights, the actual bonds and the Treasury futures moved significantly, but the curve stayed intact. And that's what the Treasury curve provides you, is a very easy hedge. When you get those large directional moves, sometimes you can count on the curve remaining intact. And in this particular case, that's where the protection was.
What do you think causes a move like that? Is that like a short squeeze on one side? Like what causes, when you see the TLT to spike up like that? Is it just fear and everybody jumping into the bonds? What causes a move like that?
The way I see it is basically, first of all, the caveat is that nobody knows. You got to understand whenever people are providing a reason or market color, it's a best guess. It might explain part of it. The way I see it is basically, what caused a short-term move was long-term interests. And that's difficult for people to sort of conceptualize because you want to assign a reason that today something happened and today the market moved. But I think basically what's driving the market right now is, a lot of long-term interest, long-term plays, long-term VWAP and TWAPs that were entered into months ago when large money players and hedge funds and, insurance companies, made certain decisions, had to hedge certain exposures, and decided to enter into 6-month, 12-month, 18-month, VWAP and TWAPs, which mean that you're going to get, fairly, regular, large, bursts of, of volume. And I think that what we saw was, we saw a large pause, in that period where none of these interests were lining up. And then we saw them all hit at the same time, all of them aligned at the same time. And I think that the reason for that spike was nothing more than long-term interests all just coming in at the same time. And I think that we'll probably see that continuing for the next couple of months. But, basically people want a short-term explanation for why the market moved in short term. But the fact is, I think it was influenced by long-term factors and long-term interests.
Does liquidity have anything to do with it? Do you notice the liquidity going down in instances, obviously, where volatility is increasing? I think that it's a very normal dynamic when you get these short-term volatility bursts. You do see, liquidity sort of fleeing the top of book. Whether it's gone or whether it goes to the deeper levels, it's tough to know. But it's a very natural thing. It's when a city bus comes too close to the curb too fast, everybody backs up, right? It's the same thing. Yeah, so it's always normal market making activity. I mean, even back in the day when nobody wants to get run over as a market maker, if you're out there trying to scalp a penny or two, you don't want to lose $1 or two, right?
It's natural. The market starts swinging wild, and you widen your market. That is standard market maker behavior. Absolutely.
And are you just trading the Treasury complex? Do you ever venture in to the equity futures or anything like that, or your strategy is pretty much relegated to the interest rate futures?
Well, we definitely have SPU futures strategies, and we basically. Our strategies even venture into currency futures and that kind of thing. We try to engage in market agnostic strategies, which scale easily across asset class. We're heavily concentrated in the treasuries, but it's a constant process to scale out beyond that, which that's where we're at.
Have you ventured outside the U.S. markets? Do you trade any futures, of the other markets?
When I was getting started, the shop I was in, there was a good amount of volume in Euro govies, LIBOR, Euribor, and those kinds of short-term interest rate products. Even the yen and dollar LIBOR and that kind of thing. I'm very interested in that. Specifically, what else were you? Did you have anything specific in mind?
I was just wondering, even from like you say that you trade the S&P futures, you trade the Nikkei futures overnight. Do you trade any other of the major foreign futures?
I haven't gotten into that. I've got Nasdaq and Russell futures, but no, none of the international markets yet. But definitely looking at it.
Okay.
And you have the same time holding period. I mean, I know you're pretty quick on the Treasuries. Is it the way that you trade the S&Ps? Is it pretty much the the same, just looking for price discrepancies in and out, quick trades?
Yeah, there's a couple basic categories of strategy that that we fit, that the different instruments will fit into. And for our S&P strategy, it's very, very short holding period. Nothing longer than a few minutes at most.
Really, a few minutes, and so your strategies, you put in a trade, it automatically enters a stop for you and a target.
For every entry we make, absolutely, we are, we have a static entry and a static stop, 100%. So the risk is constrained, from the minute of entry. That's correct.
How many of your orders get canceled there, Ezra? Because market makers obviously have to adjust orders all the time as the markets are moving. Do you know what your order cancellation rate is? Like, are you getting fill on 10% of your orders, 5% of your orders, 20% of your orders? What's your fill rate? If you don't mind.
I think that, sure. Our fill rate is significantly higher than most of our peers, I think.
Okay.
And basically, the way we look at it is that cancellations, while necessary, sometimes cancellations can be costly, and excessive cancellations can be very costly. And the reason for that is that when, we have to always can be considering our message throughput. Basically, we are constantly sending messages to and from the exchange. And our biggest latency competitor is ourselves. Because if we're sending a bunch of cancellation messages, that ties up our own transmission, that ties up our network cards, and that actually makes it more difficult for us to transmit and receive, our important, order information and fills. So basically, we try to be very messaging conservative here, and that begins with doing away with unnecessary cancellations. So we have a number of methods to drastically, bring up our fill percentage, bring down our cancellation percentage, because we find a direct correlation actually between your fill ratio and our profitability.
Ezra, one more question for you before we let you go here. Obviously your systems are, based on, the liquidity that's out there, a lot of factors. But, if you just take off that hat for a second and, you look at the recent move that we've had in the S&Ps there, hitting 1813 last week and just one heck of a rally here. Appear to be stalling a little bit. Just if you take off your high frequency trading hat and you just look at these moves off the lows, people getting freaking out, selling at the bottom, chasing all the way back up. Does this? I mean, just looking at it, just from a pure technical standpoint here, is this current up move, in your opinion, sustainable without a little bit of pulling back, a little backing and filling?
Basically, and so obviously, just from a trader standpoint, I'm looking at the 1 year S&Ps right now, and I think that still I think we're looking at a long-term bull market, and it's going to test your average investor, because the one thing you can always count on is the pain trade, right? Mm-hmm. And so I think that it's going to test your long, it's going to test your longs, it's going to test your shorts. But I think really, the only people who are going to come out of this thing happy in 5 and 10 years are going to be the people who just stuck it out long. I really think that, the effects of Fed's QE, basically allowing corporations to float 10-year debt at incredibly low rates, and we're going to see the benefits of that for at least 10 years, I think. We are looking at a very long-term bull market, and I would not get shaken by these by little short-term moves. It's going to test your resolve, but I really think that I think that if you can withstand the volatility, I think long for long is the way to be.
Hey, I threw a tough one at you, and that was a great answer. Thank you very much. Ezra Rapoport, trader and head of automated strategies and development for Flammarion Capital. Ezra, thanks a lot. Great to talk to you again. We hope to have you on again soon.
I look forward to it. Always a pleasure. Thank you.